Hello and welcome to a recap of our lecture on financial instruments classification. Remember, the key to this was that we need to classify our financial instruments and then we'll need to treat them. So the classification will lead us to the treatment, which we look at in the next lecture. So some definitions. First of all, a financial instrument was the contract that gives rise to a financial asset in one entity and a financial liability in another entity. So let's say some bonds that are issued by a company. Well, that's a liability to them because they've raised some debt. Another company may buy those bonds. Well, that will be an asset to them because they will get the interest and capital on those bonds. So that, simply spoken, is a financial instrument. IAS 32 outlines some of the classifications, and a financial asset is defined as cash, equity of another entity, or a contract to receive cash, or a financial asset. So all of those are fairly straightforward. Cash is cash, equity of another entity is the shares of another entity, and that will be a financial asset, or a contract to receive cash or a financial asset. For example, a receivable. Also, we have a contract to exchange financial instruments under potentially favourable conditions. So if you're going to have something coming to you that's potentially favourably to you, that is going to be a financial asset. A financial liability, well, this is a contract to deliver cash or exchange financial instruments in potentially unfavourable conditions, i.e. you're going to make a loss on it. An equity instrument is not for cash or another asset, but is settled in shares. So don't worry too much about those definitions. We went through the simple ways to remember them in the full lecture. Go back to that if you're not sure how to do it. Financial assets then, we classify these under IFRS 9. So examples of financial assets will be an investment in shares, investment in bonds, receivables, or indeed options. Those would all be examples of financial assets that a company could hold. When do we initially recognize them? Well, when we're party to the contract, i.e. when we buy them. So when we're party to the instrument, when we buy it. Initial measurement, well, initial measurement will be at fair value, i.e. the amount that we actually purchased it for, and we'll exclude transaction costs if it's at fair value through profit and loss, which we'll look at later. So we needed to learn our new debt tests under IFRS 9. The things we had to think about were if we hold the bonds of another company. So if it's a financial asset, that is debt. So how are we going to classify the bonds of another company if we own them? And we had two tests to do this. The first test was the business model test. What is the objective of our entity's business model? The objective was either to hold the bonds to collect the cash flow, i.e. to hold the bonds and get the interest and capital each year, or to sell the bond to realise the fair value changes, to make a profit or a loss. So that was the business model test. The contractual cash flows test, well, this was asking us, do the terms of the asset give rise on specific dates to cash flows that are solely payments of interest and capital? I know that sounds complicated, but all it's saying is the only thing we're going to get on this bond interest and capital? An example of something where you would get something other than interest and capital would be convertible debt, because we'd have the option to convert that. Basically, all other bonds will just have interest and capital paid on them. So that's the question we need to ask ourselves. So when we're looking at debt, we need to check what our test results were. And if our test results were that for the business model test, we're going to hold it, not sell it, and for the contractual cash flows test, if it's only principal and interest, well, if it's both of those things, we'll hold it at amortized cost. If it fails on either of those tests, i.e. if our business model is to sell it, or if it is not just principal and interest, well then it won't be at amortized cost, and it will be at fair value through profit and loss. So any that don't pass those two tests will be held at fair value through profit and loss. What about equity? Well, the two tests don't apply to equity. What we simply ask ourselves is, it will be at fair value through profit and loss, FVPL. We'll look at what that is in the next lecture. Unless it's not held for trading purposes, i.e. it's held for a long-term investment. So anything held for trading purposes will be fair value through profit and loss. If it's not for trading purposes, it will be fair value through other comprehensive income. Once you've decided on that, you can't change the classification. So you can't change from fair value through profit and loss to fair value through other comprehensive income. So what you need to do is learn the table for these in the workbook. That will tell you how to classify any financial asset. Another area just on reclassification between our amortized cost and fair value through profit and loss for bonds. So we're thinking of a financial asset that is bonds. Well, if we're going to change from amortized cost to fair value through profit and loss, well, we need to have changed our business model. Remember, we ask ourselves, is our business model to hold, not sell, or to sell to get a profit or loss? Well, if we change our business model from hold, not sell to deciding to sell, well, then we could change from amortized cost to fair value through profit and loss. We can only do this if it's infrequent, and we have to apply it to all similar assets. So for example, if we were a mortgage company, we were issuing mortgages and getting the interest and capital, but we've decided not to do that anymore and sold all of our mortgages. We could reclassify them from amortized cost to fair value through profit and loss. So that is everything for financial assets. Financial liabilities, remember, these will be things like trade payables, bonds and debentures that we have issued to raise capital, or redeemable preference shares that we have issued to raise capital. They could be held at fair value through profit and loss if they're held for trading purposes. This will really only be short-term things like derivatives, options, futures, those sorts of things that we're making a loss on. If we're holding them for trading purposes, we're making a loss, there'll be a liability, fair value through profit and loss. Revalue them to fair value each year, and the gain or loss goes to the income statement. Anything else will be at amortized cost. This will be the bonds or loans or shares that are redeemable that we will have. So all others will be, except fair value through profit and loss, will be at amortized cost. So how will we do that? We're going to use the same table as a lease, and we're going to look at it in the next lecture. So again, learn the table in the workbook to enable you to classify your financial liabilities.